Hey everyone, it's Justin from Number Crunch Nerds. Welcome to the Level 1 Financial Accounting Cram Session. Let's just jump right in. Here is what financial accounting is. I'm going to give you a financial transaction. Sarah purchased a car for $20,000 cash. That's a financial transaction. I am going to ask you to record a journal entry. What is a journal entry? A journal entry is basically 2 rows of text, and it is going to look like this. The first row will contain one side of the transaction. The second row will contain the other side of the same transaction. This is the first side. This is called a debit. That is the first side of the transaction. This is the second side. That is called a credit. That is the second side of the same transaction. Now, wait a minute. Do all financial transactions have 2 sides to them? The answer is yes. All financial transactions have 2 sides. Look again at this financial transaction. Sarah purchased a car for $20,000 cash. What are the 2 sides? The first side is what you received. In this example, Sarah received car. The second side is how did you pay? In this example, Sarah paid with cash. So if every financial transaction has 2 sides, then every journal entry will have 2 sides. This journal entry has 2 sides. One side of the entry records what Sarah received, in other words, the automobile. The other side records what Sarah paid, in other words, cash. You'll notice that the left side is a little bit further to the left, and the second part of the entry is a little bit further to the right. This is the journal entry format right here. The left side of every journal entry is called a debit. Why is it called a debit? I don't know. Why is a carburetor called a carburetor? It's just a name. In accounting words, the left side is called a debit. So when I say debit asset, or when I say debit liability, or when I say debit anything, I mean record the left side of the journal entry. The right side of every journal entry is called a credit. When I say credit asset, or credit liability, or credit anything, I mean record the right side of the journal entry. In this financial transaction, Sarah bought a car for $20,000 of cash. So we debit automobile to record one side of the transaction, and we credit cash to record the other side. This is debit automobile for the $20,000, the value of what was received. Credit cash, $20,000, the value of what was paid. The left side, the right side, the debit side, the credit side, both have to match in amount. In every journal entry, debits equals credits. The left side equals the right side. What you're learning today is called double entry accounting. It is called double entry because there are 2 sides to every financial transaction. There has to be 2 sides. Think about yourself for a moment. When you purchase anything, where does the money come from? Well, there are only 2 possible places. There are only 2 possible places that money can come from. Either it is your money, meaning you earned it from a job or a business, or maybe even inherited it. Either way, it is your money. You do not have to give it back. What is the only other possible place that money can come from? You borrow it. Those are the only 2 possible places that money can come from. It is either your money or you borrowed it. If you use your own money to buy a car, then you have equity in that car. If you borrow money to buy a car, then you have debt related to the car. The fundamental accounting equation is that assets equals liabilities plus owner's equity. So if Sarah purchased a $20,000 car with her own money, then the fundamental accounting equation would read $20,000 of assets, which is the car, equals 0 liabilities because she didn't borrow any money, plus $20,000 of owner's equity because she used her own money to buy the car. If Sarah purchased a $20,000 car by borrowing money, then the fundamental accounting equation would read $20,000 assets, that's the value of the car, equals $20,000 liabilities, that's the amount of money that she borrowed, plus 0 owner's equity because she doesn't have any equity in the car because she didn't use any of her own money to purchase it. She borrowed the full amount. Let's do some financial accounting. I am going to give you 2 financial transactions. Here they are. Sarah started a business by contributing $40,000 in cash in exchange for 5,000 shares of common stock. The second transaction, Sarah Company, she now contributed to a company, so Sarah Company, then purchased a $20,000 automobile to make deliveries. She put $5,000 down and financed the remaining $15,000. Prepare the journal entries. So, journal entry number 1. What are the 2 sides of the first transaction? The first transaction was this. She started a business by contributing $40,000 in cash in exchange for stock. The number of shares of stock doesn't matter. That's just a number there that might distract you. What matters is the dollar amount. This number is not relevant. So she put in cash as an asset, into the business. That was the first side of the first transaction. She put in her own money, not borrowed money, so she has equity in the business. The accounting words to record this journal entry, therefore, are debit asset for $40,000, specifically debit cash for $40,000, and credit owner's equity for $40,000. Credit owner's equity for $40,000. Now, wait a second. How do we know if we're supposed to debit asset or if we're supposed to credit asset in that transaction? Let's go back here for a second. The accounting words were debit asset for $40,000, debit cash for $40,000. How do we know it wasn't a credit to cash? Credit owner's equity for $40,000. How do we know it wasn't a debit? How do we know it's supposed to be debit cash, credit, owner's equity? That is the question. How do we know which one it is supposed to be? I want you to remember this. Assets increase with a debit. That is the only phrase you ever need to memorize. Assets increase with a debit. Let me say that again. That is the only phrase you ever need to memorize, and you will never be confused about debits and credits again. Just memorize this one phrase. Assets increase with a debit. If you can just memorize this one phrase, everything which comes after that is just going to be logic. Let's get into it. Now, follow along. If assets increase with a debit and liabilities and owner's equity have to work the opposite way of assets, liabilities and owner's equity have to work the opposite way, then liabilities and owner's equity must increase with a what? With a credit. Let me say that again. Assets increase with a debit. Liabilities and owner's equity have to work the opposite way. Therefore, liabilities and owner's equity have to increase with what? A credit. But wait a minute. Why do liabilities and owner's equity have to work the opposite way? The answer is because they are on the other side of the fundamental accounting equation. Look up here. Here is assets. Assets is on left side of the fundamental accounting equation. Here is the equal sign. These two are on the other side of the fundamental accounting equation. That means whatever assets does, these two have to do the opposite. If the only thing you need to remember is assets increases with a debit, then immediately you know liabilities and equity must increase with a credit. If assets increases with a debit, then how does assets decrease? Well, it must decrease with a credit. If it increases with a debit, it must decrease with a credit. And if assets decreases with a credit, and these two are on the other side of the fundamental accounting equation, how do these decrease? With a debit. Asset decreases with a credit. That means these two have to decrease with a debit. Let's take a look at the first transaction from Sarah Company again. Sarah started a business by contributing $40,000 in cash in exchange for 5,000 shares of common stock. Cash is an asset. Assets increase with what? A debit. She contributed her own money, i.e. she didn't borrow any money. So she has equity in this business. Equity is on the other side of the fundamental accounting equation. So equity increases with what? A credit. Let's put it in the accounts over here. She contributed cash, $40,000, debit, the asset. The other side of the entry, because it's her own money, not borrowed money, is equity. If assets increases with a debit, then equity increases with what? A credit. Notice how I put them in the accounts here. This is the debit side of this account. This is the credit side of this account. What is the journal entry? Debit, cash, $40,000. Credit, owner's equity, $40,000. That's the same as what is going on up here. $40,000 debit asset, $40,000 credit for owner's equity. Let's look at the second transaction by Sarah Company. Sarah purchased a $20,000 automobile to make deliveries. She put $5,000 down and financed the remaining $15,000. So let's follow the logic. If assets increase with a debit, then assets increase with what? A credit. So if assets decrease with a credit and she put $5,000 down, meaning she put $5,000 down in cash, then cash will go down by $5,000. Cash goes down with a credit. Assets increase with a debit, assets decrease with a credit. If assets increase with a debit, remember this is the phrase you're supposed to memorize, and liabilities are on the other side of the accounting equation, then liabilities increase with what? A credit. They increase with the opposite of whatever assets is doing. So liabilities increase with a credit. Do we have a liability here? She put down $5,000 in cash and financed the remaining $15,000. What does financed mean? It means she borrowed money. It could say she took out a note. She took out a mortgage in the case of a house. Anything that indicates that she borrowed money. Financed means she borrowed money. So liabilities goes up by $15,000. That's one side of the transaction. These two right here represent one side of the transaction. That's how she paid. What did she get? She got an automobile for $20,000. All right? This is the assets section of the fundamental accounting equation. Within the assets section, there's more than one account. There can be many accounts. In this case, we have two accounts. Here's cash, that's one account. Vehicles, that's another asset. So assets is going to increase by $20,000. Do debits equal credits? Remember, debits always have to equal credits. Here's my debit, vehicle, $20,000. What are my credits? A decrease to cash of $5,000 plus an increase to liability of $15,000. My credits equal 20. My debit is 20. Debits and credits are the same. What is the journal entry to record the second transaction? Sarah Company purchased the $20,000 automobile. She put $5,000 down and remained and financed the remaining $15,000. So let's say the accounting words together as we make the entry. So what is the debit to? Well, it's going to be to vehicles. You could put automobiles here. You could put car or truck. You can put any word here that indicates whatever is relevant to the problem. All right. In this case, I'm just going to put vehicles, and I'm going to come over here and I'm going to debit $20,000 for the vehicle. Now, what is the credit? Well, what is the first way that she paid? She paid in cash. So that's my first credit. Cash is an asset. Assets decrease with the credit. So I'm going to go over here and I'm going to enter $5,000. We are making the journal entry right now. Okay. The next item on the list is note payable. Note payable. You could put loan. You could put auto loan. You could put vehicle loan. You can put any words here that are representative of whatever the transaction is. Note payable is a very common one in an accounting class. So I'm just going to put that. The amount was $15,000. Credit note payable. Debit vehicles to increase the value of the asset. Credit cash to decrease the amount of cash because you put $5,000 down. Credit note payable for the amount that was financed, which was $15,000. You'll notice that debits equal credits. You'll notice that this debit and this debit is the same. You'll notice that these two credits here are the same as these two. Okay, this is a journal entry. This is entering the numbers in what's called a T account. A T account just looks like a T. The left side is a debit, the right side is a credit. Now, wait just a second. I thought a journal entry only had 2 lines of text. This journal entry right here has 3 lines of text. Let's change the wording slightly. Journal entries have at least 2 lines of text. 2 minimum, because there is always 2 sides to every transaction. There's still 2 sides to this transaction. We could have recorded the second transaction like this. We could have said, okay, she paid $5,000 in cash. She put down $5,000. So we're going to credit cash to reduce it. And we're going to debit vehicle, an asset. Assets increase with a debit for just the $5,000. And then we're going to debit vehicles again in a separate entry for the $15,000 that she financed and credit note payable, a liability. Liabilities increase with a credit, and credit liability. We could have separated it out into 1 and then 2 different entries. There are still 2 sides to this transaction, what you got and what you paid. In this example, she happened to have paid in 2 different ways, partially in cash, partially in note payable. So we certainly could have recorded it in this broken out version with a separate line for each way that she paid. However, what we recorded and what you are required to understand is called a compound entry. A compound entry will have 3 or more lines of text. Okay, let's go back here. This is a compound entry. What she got, and then the 2 different ways which she paid for that transaction. Okay, next. The complete fundamental accounting equation reads as follows. Assets equals liabilities plus owner's equity plus revenue minus expense. Okay, now I want you to follow the logic here. If equity increases with a credit and revenue has the same sign as equity, let's stop for a minute. Let's go up to the fundamental accounting equation. This is our asset side. There's the equal sign, so everything else is on the other side of the equation. Assets is on one side, right here. Everything else is on the other side, okay? Equity, on this side of the accounting equation, equity has a positive, is a plus sign right here. Equity has a positive sign, okay? If equity increases with a credit and revenue has the same sign as equity, which it does right here. Remember, it's plus owner's equity plus revenue. Those 2 have the same sign. Revenue has the same sign. then revenue increases with what? It increases with a credit. It increases the same way as equity does with a credit, because these two have the same sign right here. Remember, now what if we're getting confused? Go back right to the beginning. Assets increases with a debit. If assets increases with a debit, we know equity increases with a credit, because equity always does the opposite of whatever assets does. And because assets increases with a credit. If revenue has the same sign as assets, then revenue increases with a credit also. It's all logic once you remember the one sentence, assets increases with a debit. If equity increases with a credit and expense has the opposite sign of equity, which it does, let's go up here, expense is a minus, expense is a negative in this equation. So assets equals liabilities plus owner's equity plus revenue minus expense. So expense has the opposite sign of equity. If equity increases with a credit and expense has the opposite sign of equity, then expense increases with what? A debit. It can all be found logically. You just follow the logic along. Equity increases with a credit. We know this is the opposite sign, therefore expense has to increase with a debit. All right, let's do some financial accounting. I am going to give you 5 additional transactions to record for Sarah Company. Here we go. Sarah provided services to a customer for $10,000 in cash. What is the journal entry? So, what are the two sides of this transaction? She provided services. That's the first side. That's what she gave. And what did she receive? She received $10,000 in cash. Cash is the easy one. We know cash is an asset. How do assets increase? With a debit. So cash increased with an asset because she received cash of $10,000. Okay. We also know that the credit has to be the same number, don't we? We know that. So we already know what the credit is. What is the description going to be right here? What did she provide? She provided services. What is the word that is used in accounting when a business provides services to someone else? The word is revenue. The word you're looking for is revenue. In particular, and to be more specific, you could write services revenue. Okay? So it's debit cash for what she received, $10,000. Credit services revenue. This is a revenue account. Revenue increases with a credit. So revenue went up by 10. This is an asset. Asset increases with a debit. Asset went up by 10. Next entry. Sarah paid rent expense of $4,000 in cash. So what are the two sides? One is that she incurred an expense called rent from renting a facility. The other side is that she paid for it with cash. What did she get? She got to rent a building or some kind of facility. She incurred rent expense for that. What did she give? She gave cash. So how does cash go up? How does assets go up? With a debit. So how does cash go down? With a credit. So we're going to put cash here. That's the easier side, quote unquote, of the entry. We know that cash went down. Cash goes down with a credit. So we're going to put a credit here for $4,000. Notice that you don't have to necessarily write the debit first. You can write the credit first if you would like to. And we know that the debit amount is going to have to be the same because debits have to equal credits. So the only question now is, what is the description that is going to go right here? Well, what did she incur? Well, rent expense. Says right there in the problem. So this is an expense. Expense is has the opposite sign of owner's equity, remember? So expense increases with a debit. So increase the rent expense, increase the expense by $4,000. This is an asset. Assets decrease with a credit. Decrease asset right here. Next entry. Sarah paid $2,000 toward the note on her delivery vehicle. So remember, a few slides ago, she purchased a delivery vehicle and financed some portion of it. Okay, now she's paying off a part of that note. She's paying off $2,000 of the note. So We know what the credit's going to be, right? That's going to be pretty straightforward. The credit is going to be to what? Cash. She paid in cash. And we know that assets decrease with a credit, so we're going to credit asset for $2,000. That's the easy part. Oh, and we also know that the debit has got to equal the credit, so we know that that is going to be $2,000. Now, the question is, what is going to be the description that we put right here for this debit? Well, what is she paying off? She's paying off the note payable that we recorded earlier. So, note payable. Note payable is a liability. How do liabilities increase? They increase with credits. So how do they decrease? They decrease with a debit. Liabilities decrease with a debit. This is the decrease of her note, the decrease of the money she owes, the decrease of her liability. Liabilities decrease with a debit. This is the asset. Asset decreases with a credit. Next entry. Sarah purchased $5,000 of inventory on account. What does that mean, on account? That's a phrase you need to watch for. Sarah purchased $5,000 of inventory on account. On account means she didn't pay in cash. In the normal course of business, companies will often purchase on temporary lines of credit. Temporary lines of credit are known as accounts payable from an accounting perspective. So when you see that Sarah purchased $5,000 of inventory on account, it means she didn't pay cash. Instead, she has an IOU, essentially, to the supplier of the inventory to pay cash later, and that IOU is called accounts payable. Okay, so let's record the entry. What did she get? She got inventory. Inventory is an asset. Assets increase with a debit. So we're going to debit inventory for $5,000. And then the other side of the entry, we know that's $5,000. And what did we just say it was called? It's going to be called accounts payable. Accounts payable, because she didn't pay in cash. Next entry. Sarah paid $1,000 to the supplier of the inventory. What is the journal entry? Okay, so now in item 6, in journal entry 6, Sarah purchased the inventory on account. Now, Sarah paid $1,000 to the supplier of the inventory. She made a partial payment of what she owed. She purchased $5,000 total. Now she paid $1,000. Okay, so what is the easier side of the entry? Well, we know she paid, right? And so if she paid, that's cash. So we know that. We're going to put that down, $1,000 credit to reduce the asset cash. We know that the other side is going to be $1,000, the debit side. And what is that going to be too? Well, in entry number 6, she recorded an accounts payable for the full amount that she owed. So if she pays some of it off, what's going to happen? She's going to reduce the accounts payable. Accounts payable is a liability. How do you reduce a liability? With a debit. So debit accounts payable for $1,000 to reduce the liability, and credit cash to reduce the asset by $1,000 for the amount that you paid. Okay, here are the 7 transactions we have recorded for Sarah Company so far. We are now going to post them to the general ledger. Okay, this is what a general journal entry would look like. It would be each journal entry just listed in a row. You can imagine this in Excel. You can imagine this in some kind of accounting software or financial system. You just have every transaction lined up here in this order. It says what the transaction number was. There could be some other kinds of references. It says what the debit and the credits amount are. This is where this is the general journal. This is where all the journal entries are located. The next step in the process is to post them. It is called posting them to the general ledger. A general ledger looks like this, and it has all of the various accounts located inside the general ledger. So we have cash, we have accounts payable, we have equity, we have vehicles, we have notes payable, etc. We have all these accounts. A journal entry just shows one transaction, but there can be multiple transactions involving the same account. For example, this transaction had cash involved, this transaction had cash involved, this transaction had cash involved. So it's very hard to know what to do with all these numbers, what the totals are, how much cash you may have left, etc., if you don't organize it in some fashion. And so posting the journal entries to the ledger is the process of organizing the journal entries into individual accounts. So then you can add them up and see how much is in there. Okay, so the first two entries we had posted to the general ledger already. If you recall, we increased cash and we increased owner's equity for the cash she contributed to the business. We increased vehicles by $20,000 for the purchase of the vehicle right here. And then the other side of that was $5,000 down plus $15,000 notes. All right, now we're going to start posting these together. So entry number 3 was a debit to cash. So I'm going to go over here. I'm going to type 10,000. The other side of the entry, services revenue, that's a credit. I'm going to go to the services revenue account. I'm going to type in 10,000. Rent expense, debit 4,000. I'm going to go here, debit 4,000. Cash went down with a credit. Cash is an asset. Assets go down with a credit by 4,000. Next entry, notes payable. This is a debit to notes payable. Notes payable is a liability. Liabilities decrease with a debit. I'm going to go over here and I'm going to put 2,000 in on the debit side. This is when she started to pay off the note on the automobile that she had taken out previously. She paid with cash. Cash is an asset. Assets decrease with a credit, so I'm going to go here and I'm going to put 2,000 in on the credit side. Next entry. This is when she started to purchase inventory on account. So we have the asset inventory for 5,000. Assets increase with a debit. I'm going to put 5,000 right there. The other side is accounts payable. Accounts payable is a liability. Liabilities increase with a credit, and so I'm going to put 5,000 right here. The last entry is accounts payable debit, cash credit. So this is when she started to pay down the accounts payable. Accounts payable is a liability. Liabilities go down with a debit. So we're going to go here and we're going to put 1,000 in to reduce that liability. And then we're going to put in 1,000 right here because she paid in cash. Okay, now the next step that we're going to do in each one of these accounts, what you have to do is total up the balances. And the way that you're going to do it is very simple. You go to the bottom of wherever the numbers stop. You put a line to show that you're going to do a calculation. We're going to sum up both sides of this account. We're going to sum up the debit side, and then we're going to sum up the credit side. And then we're going to put another line right here. Okay? Whichever number is the bigger number, you're going to make the next entry under that. You're going to take the larger number right here, and you're going to subtract off the smaller number, and you're going to get an answer. And this answer right here is going to be the balance in this account. Let's follow along and make sure we understand. This account had $50,000 in debits. This account had $12,000 in credits. If you take the debits and you subtract off the credits, that leaves $38,000 debit balance in this account. And the account is cash. Cash is an asset. Assets normally have a debit balance. So this looks appropriate. Let's go to the next one. I'm going to make a line right here to show I'm going to do a calculation. This only has one number on each side, so we don't have to sum up anything. I'm going to go to the side that has the larger number on it. I'm going to take that larger number and I'm going to subtract from it the smaller number. This account, accounts payable, has a balance of 4,000. It is a credit balance. This is a liability account. Liability accounts tend to generally have credit balances. So this looks appropriate. This account, there's nothing to add up. This is the balance right here. There's no other entries in this account, so that's the balance. Same with this one, same with this one, same with this one, same with this one. All of these, that's the balance. If there were lots of other entries, okay, these can be very, very long. These can have lots of entries on both sides in a real world situation. You would do the exact same thing here. You just add it all up and take the larger number, subtract off the smaller number to determine what the balance is. This one right here, this one only has one set of numbers, so we're going to take the 15 and we're going to subtract off the 2,000, and that's going to give us a balance in notes payable of 13,000. All right, next slide. Here is the general journal that we just created. This is the exact same picture from the previous page. Once you have the general journal complete, meaning you have added up all the balances and you have figured out what they are, you have an ending balance in each account like we have right here. Now we're going to use the account balances in the general ledger. Now that they have been determined, we're going to use that information to prepare the trial balance. What is a trial balance? It is going to take all of these balances right here and it's going to put them side by side and it's going to check if it actually balances, meaning if debits equal credits. So what I'm going to do is I'm going to go over here and I'm just going to take my balance. There's my cash balance. We know cash has a debit balance. Vehicles has a debit balance. Inventory has a debit balance. Accounts payable has a credit balance, so I'm going to have to go over here. Accounts payable. Notes payable has a credit balance. Equity has a credit balance. Revenue has a credit balance. Expense has a credit balance. I add all of the debit balances against all of the credit balances, and we see that they sum to the same amount. That is the purpose of a trial balance. Typically, when you prepare a trial balance, note that you will have the name of the company, the phrase trial balance, and then you will put the date here. This is a typical header for a trial balance. So if you put these numbers in here and you get an answer that is not balancing, then you have to go back through the steps that we went through to figure out where the error might be. That is something that accountants have to do all the time. Sometimes this just won't balance and they have to go back and find where the error is. Once you have this balancing, which we do in this case, it is time to move to the next step. Okay, using the trial balance, post the closing entries and then prepare a post-close trial balance plus an income statement and balance sheet. Okay, so in order to accomplish this, let's make sure we understand the difference between an income statement and a balance sheet. An income statement shows the company's revenue, expense, and net income for a period of time. For example, for the year ending December 31st, 2022. A balance sheet shows the company's assets, liabilities, and owner's equity from inception to the balance sheet date. The income statement for each accounting period, i.e. each period of time, is closed to the balance sheet at the end of the period. Say what? Let us do an example to make that more clear. Here is an example of closing the income statement to the balance sheet so it is very, very clear the difference between these two with respect to time periods. In year one, you sell customers $1,500 worth of products. Your cost to sell is $500. Your net income is $1,000. I want you to look down here. This is where we're going to keep track of the income statement. We're going to keep track of net income in these rows or in these cells right here. Okay, remember that income statement is for a fixed period of time. For example, 1 year. The income statement is not cumulative, meaning this income statement is prepared and then it's over. It is what it is. It ends at a certain date. then the next year's income statement, then the next year's, then the next year's. These are independent of each other. This is a completely separate time period than this. This is where we're going to keep track of balance sheet down here. For balance sheet, we're going to keep track of retained earnings. Retained earnings is a cumulative amount of net income. A balance sheet is cumulative for all periods from inception to the current date. That is why the balance sheet is for a specific date, not a year, but an actual date, like this day right here, December 31st of year one. The balance sheet is as of that date. So we're going to accumulate in the balance sheet. So let's do it. We have the year one, we sell the products $1,500. Costs are $500. Net income is $1,000. I'm going to put $1,000 of net income right here. And because this is the first year, when I close this income statement to the balance sheet, my retained earnings is going to be $1,000. Now in year two, I sell $1,500 of products. The cost is $400. Net income is $1,100. So I have $1,100 of net income on this year's income statement. But on this balance sheet, because it's cumulative, my net income will equal this $1,000 right here from the previous period, plus the new amount right here. So retained earnings is going to be a cumulative amount. The previous year's plus this year's. Year number 3, I sell $1,500 of products, costs are $3. Your net income is $12. I have $1,200 right here. Balance sheet is a cumulative amount. I take the previous year's amount and I add in the current year's net income. Now the balance sheet shows $3,300 of retained earnings. Let's do one more year. $5,000 of products sold. Your cost to sell, $2,000. Your net income, $3,000. We're going to have $3,000 on this year's income statement, right? This year's income statement has nothing to do with these income statements. This is a separate income statement for this period of time. However, my balance sheet is cumulative. I'm going to take everything that was there before and I'm going to add in the new amount. I'm going to close the income statement to the balance sheet. Close the income statement to the balance sheet. So the balance sheet is everything through the balance sheet date, whereas the income statement is just for one period of time, and then it stops, and then a new income statement begins, or a new income statement period begins. Okay? So let's go back here. We're going to use the trial balance. We're going to post the closing entries, and then we're going to prepare the post-close trial balance, income statement, and the balance sheet. The act of closing the income statement accounts to the balance sheet accounts is called closing entries. Okay, that's what we just talked about on the previous page. We showed at a high level closing the income statement to the balance sheet. We're going to do it in journal entry form now. Closing entries are just entries. They're just journal entries. They're just 2 lines of text, the same format that we saw already. For Sarah Company, using this trial balance right here, the closing entries are as follows. Now, before I start entering them, let's make sure we understand what we have to do. We have to close the income statement to the balance sheet, which when we're looking at individual accounts, what does that mean? It means we have to close the income statement accounts to the balance sheet. On this list of accounts, which ones are the income statement accounts? It's going to be revenue and expense. These are my income statement accounts. These are all balance sheet accounts. That's an asset. That's an asset. Inventory is an asset. Accounts payable is a liability. Notes payable is a liability. That is owner's equity. This is revenue and expense. These are my income statement accounts right here. So here's what we do. I have services revenue right here. It has a credit balance. So to close this, in other words, to make this 0, what do I have to do if it has a credit balance? I have to debit it. All right. So I'm going to go up here and I'm going to, for 10,000, I'm going to debit services revenue. And I'm just going to link this right here. There we go. Services revenue. I debited that for $10,000. That means the credit balance that's here is going to go to 0 because I just entered a debit. What is the other side of this entry? The balance sheet account. We saw it on the previous slide. It's going to be called retained earnings. This is a balance sheet account. It's not on the trial balance yet, but we're going to put it on the trial balance in a minute. Retained earnings. The reason it's not on the trial balance right now is because we're assuming this is the first year of this company. Okay, there's nothing been accumulated yet. That's why there's no account with a balance in it yet. Retained earnings, we're going to credit it for $10,000. If this was not the first year of this company, there would be an account here already called retained earnings, and there would be a balance in it. Let's go back to this slide real quick. Remember, retained earnings keeps accumulating every year. So if it wasn't the first year, there'd be a balance accumulated in it already. So for this Sarah company, this is the first year that she is in business. All right, so we have zeroed out the revenue account, which is an income statement account with this entry. Now we have to do the same thing for the expense accounts. So this is the expense account. The expense account has a debit balance. So what are we going to do with that? We're going to have to credit that. We're going to credit this account right here. And we know that this is called rent expense. I'm going to go ahead and link that. And then what is the other side of the entry? We know the debit is going to have to be for $4,000. What is it going to be to? What account? It's going to be to the balance sheet account called retained earnings. So we have closed. Let's use the accounting words here. We have closed the revenue accounts. In this case, there's only one, so we have closed the revenue account to retained earnings. We have closed the income statement to the balance sheet. Here we have closed the expense account. We have closed the income statement account to the balance sheet. Okay. By the way, after this entry, what is the balance of the retained earnings account, an equity account? What is the balance? Okay, we're going to see it on the next page. Can you see it right here? Okay, we credited it for 10. We debited it for 4. So the balance is going to be a credit balance of 6. Remember, bigger number minus smaller number. We're going to have a credit balance. That will be more clear on the next slide when we look at the ledger. So let's go back here. This is the same ledger that we had before. The only difference are the 2 entries that we just made. I have put them in right here in red. The red doesn't mean anything other than these are new from the previous picture that you saw. Okay? So if we go back here, we had a credit to retained earnings of 10 and a debit of 4. We go here, credit of 10, debit of 4. Here's the opposite side of the entry in the revenue and expense account respectively. Okay, so remember how we would total these up? We total this up and then we would take the larger number minus the smaller number. We would take the larger number minus the smaller number. Here, I'll spare you the math, but you can see that if I take one number minus the other number, the answer is 0. Okay, so these accounts have been closed to the balance sheet. These are income statement accounts. They have been closed to the balance sheet. Okay, now the next thing we're going to do is we're going to make our post-close trial balance. So here's the trial balance from before. All of the numbers from before are in there except for I have taken out these 2. Okay, these 2 are no longer in there because we have closed these accounts. What goes here? What's going to go here is the net balance. So what we have to do, as I said, we'll put a line here to show we're doing a calculation. We're going to take the larger number. We're going to subtract off the smaller number. We're going to get 6,000, and we're going to go over here and we're going to put 6,000 right there. And we're going to see that after we make that entry, the trial balance balances once again. All right, it is time to prepare the income statement. And for the income statement, we're actually going to use the pre-close trial balance because we need the income statement accounts, which are down here. So I have adjusted the trial balance back. I've taken out the retained earnings for the moment and put back the income statement accounts, because that's what we need to create the income statement in the first place before it gets closed to the trial balance. So a basic income statement has the following format: revenue minus expense equals net income. And the header for an income statement, which you need to know because you will clearly be tested on that in any basic accounting class, is name of the company is first, then the phrase income statement, and then you must write for the year end or for the period end, whatever it is, if it's a month, if it's a quarter, if it's a year, for the period ending, and then whatever the date is. All right, so an income statement, we're going to set it up just like this. We're going to first put revenue. Revenue should be the first thing. Now, if you have a lot of different kinds of revenue, you will have a whole list here. We can even do a classified income statement, which we will do in future cram sessions, which has these different types of revenue and expense categorized into different groups. But for now, we have a simple income statement because we only have two accounts. So revenue is going to be the first item. We're going to go over here. We're going to put 10,000. The next item on the list is going to be your expenses. In this case, we have 1. I'm going to put that there. I'm going to go over here. I'm going to grab the expense amount and I'm going to put it there. And you can see that this is going to be net income. Revenue minus expense equals net income. Notice that debits and credits don't apply once you get to the financial statements, okay? And the numbers are not positive and negative either. The numbers are all positive, so you have to do your addition and subtraction correctly, okay? Revenue minus expense equals this one. There's no debits and credits. Now it's all just being presented in the same format. All right, next up is the balance sheet. A balance sheet has the following format: assets, and then liabilities, and then owner's equity. So the balance sheet is a representation of the fundamental accounting formula in a what's called a financial reporting format. So this time we're going to use the post-close trial balance. So I've changed it back. I've closed out those income statement accounts again, and the $6,000 is back into retained earnings because retained earnings is a balance sheet account, so we're going to need that to prepare the balance sheet. At this point, the income statement has been closed to retained earnings. So here is the format for a basic balance sheet. We have assets is going to be listed first. I'm going to go over to the trial balance. I'm going to grab my assets. I have cash. I have vehicles. I have inventory. I'm going to go over here. I'm going to enter in the amounts on the trial balance, 38, and the others. The total here, $63,000 in total assets. Make sure to put your double line underneath the accounting way. Liabilities, next up on the balance sheet. We're going to put in our two liabilities. Right here, we have accounts payable. We also have notes payable, so we're going to put that right there. The amounts for those we're going to bring in over here, 4,000 for that one and 17,000 for that one. We don't need a double line under this because this is not a grand total yet. This is a grand total on one side of the accounting equation, and we're going to have a grand total on the other side of the accounting equation down here at the bottom. Remember, assets equals liabilities plus shareholders' equity. So we're going to see the grand total with the double line down here at the bottom in just a moment. So I'm going to bring in my two shareholders' equity items, which are common stock, and retained earnings is another item that is in the shareholders' equity section. We're going to go over here. We're going to bring in our numbers, which are 40,000 for that one, and we're going to bring down the 6,000 for that one for 46. So here you will have a total for stockholders' equity, just like you have a total for liabilities. We should have a single line right there to show that that's a summation. We have a summation here, and then this one will grab the liabilities, plus it will grab right here the total stockholders' equity, 17 plus the 46 is 63, and you can see that the 63 total assets and the 63 liabilities and shareholders' equity are the same. So the balance sheet is balancing. If this number does not balance with this number, then we would have an error somewhere along the way. So with everything that we have gone through today, tell me what the purpose of financial accounting is. Now, what you should probably be saying is that the purpose is to get ahead in life, to be the smartest person in the room, to know what others don't, to get that promotion while others are left behind. So if you really want to learn financial accounting, I mean like for real, not just dabbling around like a lot of other people, then tell me what the purpose of financial accounting is. Well, it's 5 things. It's to record, summarize, classify, report, and analyze financial transactions. Of those 5, which ones did we do today? And I'll give you a hint. We did 4 of them. The first one we did was to look at Sarah Company's financial transactions and record journal entries. That's recording financial transactions. We looked at what she did and we recorded it. The second one was to take those journal entries, post them to the ledger, and prepare a trial balance. That is summarizing financial data. We took the raw financial data and we summarized it into a more useful format. The third one we did was to take the summary data and prepare financial statements. That's called reporting financial data. That's how you report it. You report it on the balance sheet, you report it on the income statement. Later in your financial accounting career, you will report it on the statement of cash flows and the statement of owner's equity. That is how you report it. First you record it, then you summarize it, and then you report it. And the fourth one we did throughout the entire process by determining which ones were assets, which ones were liabilities, equity, revenue, expense. That is classifying financial data. You have to determine which is which, what buckets they go in, what the classification is, etc. So here is a summary of everything that we have learned today, ladies and gentlemen. We learned that the full accounting equation is assets equals liabilities plus owner's equity plus revenue minus expenses. We learned that if you just memorize one phrase, assets increase with a debit, that all other account entries can be determined logically just by remembering that one thing. We learned that journal entries have a minimum of 2 lines. That is, they have to have at least one debit and they have to have at least one credit. They could be compound, meaning they have 3 lines or more, but they have to have at least 2. We learned that entries from the journal entries in the general journal are summarized and totaled in the general ledger. We learned that the income statement is for a fixed period of time, whereas the balance sheet is cumulative from the company's inception through the balance sheet date. We learned that revenue and expense accounts are closed to retained earnings. This is how the income statement accounts are ultimately closed to the balance sheet. We learned how to use the trial balance to prepare the income statement and balance sheet. We learned that the purpose of financial accounting is to record, summarize, classify, report, and analyze financial transactions, of which we did 4 of those today. And that is going to be it for today, everyone. My name is Justin from Number Crunch Nerds, and I will see you in the next cram session.